In the late 1990s, investors believed they were witnessing the birth of a new world. The internet had arrived, companies were launching overnight, and everyone believed technology would change everything. And it did. But there was one problem. Investors became so obsessed with the future that they stopped caring about reality. Companies with no profits, sometimes not even real products, suddenly became worth billions of dollars. Then, almost overnight, the illusion shattered. The stock market collapsed, trillions of dollars disappeared, and what had once been called the greatest technological revolution became known as the dot-com bubble. Now, more than 2 decades later, something strangely familiar is happening again. This time, the technology is even more powerful, even more exciting, even more revolutionary. Artificial intelligence. From chatbots and virtual assistants to automated research, coding, design, and data analysis, AI is transforming industries faster than many experts predicted. Companies are racing to build smarter systems. Governments are investing billions. Startups are appearing almost daily with promises to reshape entire sectors. And investors are pouring enormous amounts of money into the AI economy. But behind all the excitement, a quiet question is beginning to grow louder. Are we witnessing the next technological revolution or the next financial bubble? To understand why some economists are worried, we need to look at what is actually happening in the global market. In just a few years, AI has moved from a niche technology to one of the most valuable industries on Earth. Tech companies are spending hundreds of billions of dollars building data centers, designing specialized chips, and training massive AI models that require unimaginable amounts of computing power. The scale of investment is staggering. Major technology firms are competing in what many analysts now call an AI arms race. Each company wants to build the most powerful systems, attract the most users, and dominate the future of artificial intelligence. The logic is simple. Whoever controls the most advanced AI could control the next generation of digital infrastructure. But massive opportunity also attracts massive speculation. Investors who fear missing out are rushing to buy shares in anything connected to AI. Companies that simply mention artificial intelligence in their presentations suddenly see their valuations skyrocket. Startups with limited revenue are receiving enormous funding rounds. Venture capital firms are competing aggressively to invest in the next big AI company. Stock markets are responding in the same way they often do during technology booms. Prices rise quickly, headlines become more optimistic, and the narrative begins to shift from cautious optimism to unstoppable hype. When that happens, something dangerous often begins to form. A bubble. A financial bubble occurs when asset prices rise far beyond their real economic value. Instead of being driven by profits, productivity, or sustainable growth, prices begin to rise mostly because investors believe someone else will buy the asset for even more later. In other words, expectations replace reality. History has seen this pattern many times. The tulip mania in the 1600s, when flower bulbs in the Netherlands became absurdly expensive. The railway bubble in the 1800s. The dot-com boom in the 1990s. The housing bubble that triggered the global financial crisis in 2008. Every bubble begins with something real. A genuine innovation. A true opportunity. But as excitement grows, speculation often grows faster than the underlying technology itself. This is where the concern around artificial intelligence begins. AI absolutely has the potential to reshape the global economy. It could automate tasks across finance, healthcare, manufacturing, and transportation. It could improve productivity in ways that transform how businesses operate. But the key question economists are asking is this: are current AI valuations based on realistic expectations or on exaggerated dreams about the future? Some companies in the AI space are now worth hundreds of billions of dollars, even though their profits remain relatively small compared to their market value. Investors are not just paying for current performance. They are paying for what they believe AI will become in 10 or 20 years. And when expectations about the future become too optimistic, markets can become unstable. Another factor fueling the AI boom is the fear of being left behind. Companies across industries are rushing to adopt artificial intelligence. Executives worry that if they fail to integrate AI into their products, their competitors will gain a massive advantage. So businesses are investing aggressively. Banks are experimenting with AI-powered financial analysis. Retail companies are using AI to predict consumer behavior. Media organizations are testing AI-generated content. Logistics firms are using AI to optimize delivery routes. This wave of adoption creates the appearance of unstoppable momentum. But rapid adoption also creates massive spending. Training advanced AI models requires enormous computing resources. Data centers filled with powerful processors consume huge amounts of electricity and cost billions of dollars to build. Technology companies are committing unprecedented amounts of capital to support this infrastructure. And when companies spend enormous sums chasing future profits, investors begin asking an uncomfortable question. Will these investments actually generate enough revenue to justify the cost? Because if the answer is no, financial markets eventually correct themselves. This is where the idea of an AI bubble becomes more serious. If investors suddenly lose confidence in future profits, stock prices could fall sharply. Startups that depend on continuous funding could struggle to survive. Venture capital investments might slow dramatically. The impact would not be limited to technology companies. Modern financial markets are deeply interconnected. Pension funds, mutual funds, and retirement accounts often invest heavily in large technology stocks. If those stocks decline significantly, the effect can ripple across the entire financial system. Stock markets could experience volatility. Investment portfolios could shrink. Consumer confidence could weaken. And when confidence drops, spending often follows. Companies may delay expansion plans. Hiring slows. Economic growth begins to cool. This is why technology bubbles matter far beyond the tech industry itself. But it's also important to understand that not every technological boom ends in disaster. The internet bubble of the late 1990s destroyed enormous amounts of speculative investment. But the internet itself continued transforming the world. Many of today's most powerful companies emerged from that period. Amazon survived the crash. Google was founded shortly afterward. Entire industries built around e-commerce, cloud computing, and digital services eventually reshaped the global economy. The same could happen with artificial intelligence. Even if the AI market becomes overheated, the underlying technology may still prove revolutionary over the long term. In fact, some economists believe AI could eventually increase global productivity dramatically. Automation of repetitive tasks could free human workers to focus on creative and strategic activities. Medical AI systems could help doctors diagnose diseases faster. Manufacturing processes could become more efficient. But the timing of these benefits matters. Markets often expect change to happen faster than reality allows. If investors believe AI will transform the economy within a few years, but the actual transformation takes decades, financial expectations may collapse long before the technology reaches its full potential. This mismatch between expectation and reality is the fuel that often ignites bubbles. And right now, expectations around artificial intelligence are enormous. Some analysts predict AI will add trillions of dollars to the global economy. Others warn that too much capital is flowing into the industry too quickly. Both perspectives may contain some truth. Because technological revolutions rarely follow smooth, predictable paths. They move in waves. Excitement builds, investment surges, expectations rise. And eventually, reality forces the market to slow down. The critical question is not whether artificial intelligence will change the world. It almost certainly will. The real question is whether financial markets have already priced in a future that has not yet arrived. If they have, the correction could be painful. But if the technology continues advancing and companies eventually turn today's investments into real productivity gains, the AI revolution may justify much of the current excitement. For now, the world is watching one of the most powerful technological transformations in history unfold in real time. Billions of dollars are flowing into research labs, data centers, and startups racing to build the next generation of intelligent machines. Investors are betting on a future where AI becomes as essential as electricity or the internet. And like every technological revolution before it, the line between innovation and speculation is becoming increasingly difficult to see, which means the future of the global economy may depend not only on how powerful artificial intelligence becomes, but on whether the financial system can survive the hype surrounding it.